feeling like a shark in a shrimp tank. Big fish, small pond in the shrimp tank.
Hey everyone, this is Mark Scribner, your host from the Shrimp Tank. And I have my co-host today, Mike Akil, who's in the Sarasota office. And I'd like to welcome today Tyler Winder. We're going to bring him on in just a quick second. We see him in the pane right here smiling. But I'd like to remind all our guests that the Shrimp Tank is nationally syndicated through iHeart. We're in 13 cities across the country. You can find this show, all previous shows, and shrimptank.com/Boston, iHeart, Google, Stitch, basically anywhere that you can find your podcast, you can find the Shrimp Tank. The tagline of our show is where book smarts and street smarts collide. We get to interface and ask and talk to some of the most exciting entrepreneurs in and around the country. We're excited to bring on today Tyler Winder from Winder Capital, somewhat of a newly formed company, but some great experience across his space. And so with that said, Tyler, welcome to our show today. How are you?
I'm doing well. Thank you guys so much for having me.
Great. So one of the things that, the space that you're in, which is really interesting, I think, to a lot of people, like, for example, here in Boston, we see the for lease, for sale signs basically every 10 feet. We get a lot of questions about like what the hell is going to happen with the commercial real estate market in the business world, and restaurants closing and the footprint and all that. And for the most part, almost a permanent shift in the landscape in the real estate space, because you see the companies, the Googles, the Twitters out there saying, hey, we don't have to spend all this money on real estate now. We've figured out how to make our employees work from home. And now we can increase the bottom line and not have to spend money on Class A or any kind of real estate. So, and then the banks behind that, what the hell is going to happen with how all the banks are going to be able to deal with, some of these lack of vacancies or tenants. So, well, again, welcome to the show. Maybe you could just tell us a little bit about your company, the space that you operate, and how you started.
Sure. So my company is Winder Capital. This is actually the first public message out, as of formed last week. So brand new to the market field. But what I'm primarily focused on is I'm a private equity firm focused on development and redevelopment in greater Boston and New England. So if you ever see a skyscraper going up, our company can fund that. If you look at a simple fix and flip, single family condo conversion, my company will partner with builders, developers, flippers in those projects. The benefit for the investors coming on board is they have a passive investment stream to invest in different types of real estate development.
That's interesting. It's funny, Mark and I, we have an investment committee that we work with too. So we were actually doing some research on the real estate market for the portfolios. And it was interesting. I accidentally typed in something that brought me to a website that had, online where you can now invest individually in these portfolios like this. So for our listeners out there, help me understand the difference between an income generating sort of private REIT versus utilizing the private equity, and what type of investor would be ideal for something like this?
Absolutely. So the traditional private equity or the REIT model, in my opinion, isn't really investing in real estate. An investor, you get a little piece of paper saying I'm invested in a couple hundred units over here, a couple hundred units on the other side of the country. Here's my return I'm getting. Great. It's some cash flow coming in. What mine is targeting is actual true investment into real estate, especially local. If I invest in real estate, I want to be able to walk. I want to be able to touch it, smell it, feel it, watch it grow, watch it develop, watch the for sale sign go up. That's, to me, is investing in real estate. So the way my company is different from a traditional REIT model is it's a true way to invest passively in the development project where you can watch the progress rather than just getting a rent check every month from people renting out those units.
Okay, that's good. That's a good explanation. Thank you.
So what are there's always a pro and a con, and it's a great comparison for our listeners to understand how you operate a little bit differently. But what would be some of the cons of, other than just kind of the passive or the over diversification, if you will? But what are some of the cons of being that focused, with a handful of properties? Like if you have a miss or a bogey, or in the portfolio that doesn't work, that's going to drag the overall experience down, I would assume.
Absolutely. So the biggest con with investing in my firm and what Winder Capital is targeting is it's a high risk, high reward passive fund. So a traditional model, let's say I were to buy a fix and flip, how everything operates is the first position mortgagee is going to be the bank, the private lender, hard money lender, however you finance it. They have the primary debt on the property. And with my position, I'm coming in as an equity partner. My company, my investors are an equity piece. So in the event a builder goes down, say he gets a divorce or he has family issues or goes over budget or goes and buys a boat, those are the issues that I'm personally involved with, because you're putting your money, your faith into these builders, developers, flippers, whether how experienced they are and been doing it for 30 years, or this is their first couple years doing fix and flips. You're subject to those risks. However, when people start looking into doing fix and flips themselves, the first thing they see is the margins that they're returning. The return on investment is extremely high. Even though the risk is high, that's what I'm targeting.
How long do the projects last? Like, if you're, say, are you focusing on just commercial real estate, or like, how are you finding opportunities, I guess? Where does this go?
Sure. So what I've done over the past, let's call it 28 months or so, is I was on the ground floor of a real estate development company, primarily focused in luxury single family builds in Greater Boston. So I understood that model extremely well. But to answer your question, it's going to be varied throughout a lot of different types of real estate. So the shortest term is going to be someone who's doing a quick fix and flip. They need some capital to be able to get the condo, put $60,000 in and sell it for X amount. It's going to be short term for that side, and then scale all the way up to maybe a 65 unit apartment complex going in right outside of Boston, where it's going to be an 18-month development, lease it out for another 12 months, and then sell it on the end. So it's going to be a wide range and very diversified throughout all different types of real estate.
That's interesting. Thinking about the area there, I love how you have boots on the ground. You can see the project happening. When you think about the area, what opportunities are you seeing now, whether it be because of COVID or whatever the case may be? Where are you seeing opportunities right now?
Sure. The most obvious is going to be coming out to the suburbs. Anyone who's lived in an apartment complex or high rise inside of Seaport and Financial District inside of Boston, and once they kind of shut everything down and they're waiting in line with their groceries to get on the elevator, they're craving more space to go out to the suburbs, especially if they don't have to go into the office. So immediately the first 15 miles west, north, south of Boston, you're seeing that migration, and prices have gone through the roof since the start of, mid-March, when COVID really started happening. So I think the opportunities lie in the suburbs. If you have space, if you have neighborhoods, you're really kind of making that suburban move. And then also on the other side of the coin is going to be the opportunities that will come up in the commercial field or even the foreclosure field for, I think a lot of people understand the problems that came up with the mortgage forbearance that the bank programming gave out. People who took advantage of it, they might be looking up slope saying, we might be in a little bit of trouble because I took care of this program that was supposed to help me. So in the event foreclosures go up, we're in prime position to acquire those properties and use the best means to finish the property, sell it, and take advantage of the situation.
No, Tyler, you have a lot of experience in the industry, but you're really getting into, a bigger part of your industry. And I wouldn't call you in startup mode because you have a lot of industry experience. But one of the things that we're able to do is impart some of the knowledge that our guests have to people that might be considering to get, whether it be in your space or any industry. Is there anything that you could point to right now that you kind of wish you did over, or that you find or found that there are unexpected challenges that were out there that you didn't anticipate?
Absolutely. We'll start kind of with my field. That's just because what I'm talking about and what I know. But the company that I used to work for, single family, luxury, what we kind of did right off the bat was built a big portfolio, maybe have bit off a little bit more than we could chew. If I were to go back, I would have started a little bit smaller, get the systems in place first, and then scale from there rather than scale and then figuring else out as we go. So if I could go back, that's one thing I would change. And then also the other side is commission plans and comp plans. When you're going in with a new company, with a startup, I think it's really important to see how your comp plan is and advantages that you can try to do to make sure you can maintain a salary and some sort of commissions coming through to keep you afloat. The way I kind of position myself with that company is the more success the company had, the more success I would have at the end, versus, again, starting it from the foundation and staying afloat as we go. I think those are two very important things to look into.
So what you're saying is maybe reorganize a little bit so you're more cash flow positive in the beginning. Is that what you're saying?
Absolutely. I think, I don't know the stats behind it, but I would say 90–80% of all startups fail from undercapitalization. So if you can start from that side, everything else will move a little bit slower. Might not be smooth, but at least a little bit smoother than if you were to go the other way.
Yeah, that's valuable. Absolutely. That's what we see too, that the undercapitalization, at least within those first 2 years, is make it or break it. So if you're not able to keep the lights on and you're having to make decisions about cutting back or the motivation, there's all kinds of things that happen around lack of capitalization.
Absolutely.
So tell me this: what type of what type of investment, does someone have to kind of, if they wanted to do something like this? What do you think is do you have to have investors to be able to do it this way, or were you able to do it on your own? How did you do it?
With the company I was with?
Well, the company the way you started now.
Sure. So I'm building it from ground up from investors. So I'm treating it just like a regular mutual fund, or you're going to build your IRA account. I'm building it the same way in that regard. So if you want to diversify your IRA into real estate, you have a platform to do that. So the way I'm building everything from the ground up, with Fund One, working with the SEC and the regulators, you have to be extremely cautious and dot all your I's, cross all your T's as you go. So Fund One, I'll be working with accredited investors only. A minimum investment is $50,000, and it's a 3-year term. So in the world of private equity and REITs, investing in real estate long-term, having a 3-year platform to invest is extremely short-term versus all the competitors out there on the field.
Good.
So, that saying OPM, other people's money. So you have people, you're working with these projects. Are you putting your own capital side by side, or how will that work?
Yep. So as the fund continues to grow, as the company continues to grow, I'll need to continue to invest into the fund. So as of this point, at any point of how much assets under management we have, I'll always have at least 1% of my own funds involved in the fund and continue to revolve the capital.
How big do you, do a couple things. Oftentimes the business owners that we get to fortunately work with, they have an exit plan. They have an idea of like 1, 3, 5-year business plan. Where do you see yourself in the next 1 to 3 years? And then my other question will be, do you have a business plan or an advisory board or someone that you work with to kind of, look at that timeline of where you want to be?
Well, I think if you're looking past the 3 years and the 5 years and the 10 years and you don't have a plan on where you want to get to, we have some issues right off the bat. So of course I have long-term goals. I look at the big financial companies and the investment companies out there. That's exactly where I want to be. Like I said, the fundamental issue that I'm looking to target is a way to invest in real estate without needing to put in the time, put in the sweat equity, search the market, drive around on weekends. Some people, especially now you're seeing it, people who work 70, 80 hours a week or have 3 kids, they don't have the time to invest. So putting this on a platform, growing it in the same aspect as a Northwestern Mutual, Liberty Mutual, that's what I'm really kind of targeting. In the first 1 to 3 years, first operation is relatively small, extremely small in the private equity field. But again, going back to the suggestion and the tip that I had earlier, it's you have to be able to have the foundation in place before you start taking up those additional steps. But the company will continue to grow. I think to get the most assets out on the street, it'll primarily be more targeted towards the larger scale commercial developments, whether that's apartment complexes, whether it's subdivisions, just because I can incorporate more capital at one time. First, I have 300 different fix and flips of $200,000, $300,000 condo conversions. We can go for the bigger bigger projects to routine, to get more return coming back to the investors.
That's good. Now you had mentioned a comment about IRAs. It's a little tricky putting your retirement assets in real estate, right? So can you give us a little background on how that takes place?
Sure. So it really just depends on the investor and what they're looking to do. But if you go and talk to any investment advisor, they're going to have a plan set up for you, regardless of what stage of, towards your retirement you're in. Let's call it an efficient model. You might have 60% of your assets in stocks. You might have 30% in bonds. You might have the other 10% for alternative investments. Biggest one of those is real estate. Whether you can go and buy a 2-family and rent it out and become a landlord, that's the 10%, or finding a model such as something like myself that I'm doing to diversify your portfolio to try to get those maximum returns with that 10%, 15% alternative investment space.
All right.
So yeah, I like that. In our world, it's true. I mean, there's the Blackstones of the world, the people out there, they're going for bigger projects. Do you see the play that you're creating, competing with these folks, or are you under the radar screen before they notice, or are you also potentially working, side by side, or are they competitors?
It really depends. I was looking on, I got an ad that showed up on Instagram the other day, and it was almost a $4 billion construction project going up in Manhattan. So I see that and I say, okay, there's no limit on how much you can do or how big you can get to. Blackstone incorporated, I think, $1.7 billion of debt towards that project. The rest was financed through different, financial firms. So am I going to go out and put a $2 billion loan out there right off the bat for that construction project? Absolutely. We're going to get it up tomorrow. No. So I don't think we'll be necessarily in competition, just because that's a completely different sea, different ocean, different level. But for someone who sees that project, an investor coming into that saying, well, I'm kind of invested into that project, it feels like the same of investing in real estate.
Mm-hmm. Yeah. I mean, there's a lot of opportunity in the space. I think there's a lot of potential worry too, if you're in the right. I mean, the dichotomy right now with COVID, it's either companies doing really well or really poorly.
Sure.
And, whether it be like in the biotech space, which we're fortunate enough to have in our backyard here, some of the companies that are manufacturing, vaccines or need that warehouse space, and those companies are thriving. And then obviously hospitality and restaurants and stuff like that, it's a bloodbath in that space, unfortunately. So I wanted to ask again, we try to go really back to being an entrepreneur. Do you have any like an advisory board that you work from? Like, are you just kind of like creating this on your own, or you have like a sounding board or people that you look up to from a mentor perspective? I'm just curious about that.
I really don't have anything. So I'm kind of a cowboy into the field of entrepreneurship, where I saw a vision of a better way to do the business I was doing. And I appreciate the compliments you've been saying that I'm, been involved with this field for a lot of time. I got into real estate a little over 3 years ago. I moved to Massachusetts 4 years ago. So it's not like I was born and bred in the private equity field or the development field, or even in Boston per se. But when you have a vision, when you have a model in your head, the first thing is just putting it to paper and saying, hey, how can I scale this? How can I start it? In terms of mentors, in terms of advisory boards, I really haven't had anybody besides the developers I have met and just kind of picking their brain when I'm on site, or the attorneys who are helping me along the way, or the accountants I'm referred to. Try to pick their brain in every little aspect to see how knowledgeable can I get as I continue to get everything started. I would love a mentor, but to this point, I haven't really come across one, because it's more so about getting my vision out on the street, and as employees and interns and everything start coming on board, make sure that they share that same vision that I do. So my reputation, everything continues to be displayed the right way as we get launched.
It's good stuff. Sorry, Mark, I wanted to ask him a question. Now it sounds like right now the focus is in the residential. Do you see the same opportunities in sort of the commercial sector? What are your thoughts there?
Project by project, case by case. So I'm primarily focused on the residential. I think that's where I'll get most of the traffic. But again, not even marketing this product so far. Even this morning, a developer brought me a commercial deal out in Western Mass where the margins are strong, the numbers are strong, the timeline's strong, the borrower is strong. So I absolutely look at that, of course, because at the end of the day, the more diversification for my investors for the portfolio, the better.
Yeah, it's good.
So how big do you think your fund will be, Fund 1 first year? What do you have as a plan?
Fund 1, I'm capped at 10 million. So in the private equity field is extremely small for this side of equity development and the risk associated with it. It's a large fund. The second I raise that first 10 million, it's launching Fund 2, Fund 3, Fund 4, because again, the more capital you can bring, the better you can diversify. The problem if I have right off the bat is if I'm launching a $10 million fund and say I only raised 2 million, I'm only putting a limited number of capital out on the street where that portfolio, instead of being diversified through 15, 20, 30 different markets, different borrowers, if I'm undercapitalized, that portfolio shrinks drastically. So I think a key for my success with my investors and the returns I'm looking to do is to have a successful fundraise and continue to fundraise to make that portfolio larger, larger, and larger to diversify the risk associated with it.
So it's so it seems like what you're trying to do is proof of concept, get advocates for you, make sure that you do a good job in the beginning, and then that will go a long way for you to be able to replicate Fund 1.
Absolutely. I mean, especially for the fact that I don't really have, let's call it a track record of running a PE fund. However, if the projects that I first incorporate right off the bat are returning, higher than average returns than what you're seeing else on the street, that's going to go a long way as I continue to raise the next fund, launch this, incorporate this field. Because if I have a solid foundation, like I keep referring to, apologize if I'm being redundant, but if the foundation right off the bat is strong, stable, and had success right off the bat, the other pillars that are going to follow, they're going to follow that same exact wave.
So, what's your biggest obstacle right now? Like, what do you see as being the biggest challenge that's not going to make this vision materialize?
I think there's two things. First one is internally I don't know what I don't know. So I don't know what's going to come up that I haven't seen before running my own PE firm. Maybe it's the accountant side. Maybe it's the money management side. Again, you can hire, you can grow as things grow to take care of the issues that are coming. But that's one thing I can see right off the bat that's going to put not a roadblock in front that just, divert away from the plan and just start growing a little bit slower. So that's obstacle number one. And then obstacle number two, I'm raising a large amount of funds right off the bat to deploy. And if the money is sitting in the bank, it's not doing anyone any good. So I think obstacle two is making sure I'm deploying the capital into the right markets, the right projects, rather than sitting in the banks and getting the money out there quickly to start returning that, having a strong ROI right off the bat.
So did you say the right time horizon for anyone who's interested in participating in something like this is around a 3-year? Is that what you? Okay.
Yep, it's a 3-year term. That's correct.
Okay.
That's really cool. All right. Well, Fred, conscious of time, I want to thank you for being on our show at the Shrimp Tank. I would like to remind all our listeners we're nationally syndicated through iHeart. You can find this show again through iHeart, Google Stitch, SoundCloud, anywhere. And obviously the shrimptank.com/Boston. Tyler, for our listeners, what's the best way to get your contact information or follow you on the progress of your company?
Sure. Probably the easiest way, I'm a very vocal person, a loud personality sometimes, but the easiest way to follow me is probably on LinkedIn, Tyler Winder, or you can follow along on the website or inquire about new investment opportunities on our website at windercapital.com.
Of course, right below, can't see it right now, but all your contact information will be in the video. It's Winder with a W-I-N-D-E-R, not Y. So Tyler, thanks again. We wish you a lot of success. We'd love to have you back at a future date just to hear about hopefully Fund 10 or 20 or whatever the number may be. But thanks again for your time, and we wish you the best of success.
Sounds great. Thank you both so much.
I've been feeling like a shark in a shrimp tank. Big fish, small pond in the shrimp tank.